Welcome and thanks for joining this session on using stock screeners for smarter investing, where we'll cover how these tools help you sift through many stocks to find opportunities and assess risks. Over the next few slides, I'll walk you through key concepts, practical steps, and tips to make screening a reliable part of your investment process. A stock screener is a tool that filters stocks based on criteria you choose, making research faster and more focused. There are different types: fundamental, technical, and custom screeners, and core features like customizable filters and live data that help investors quickly narrow down candidates without digging through endless reports. Using a screener saves time by automating the first pass of research, letting you scan large universes of stocks quickly instead of reviewing each company manually. Screeners also let you set precise filters to match your strategy and provide access to analytics and charts so you can spot trends and make more informed decisions faster. When choosing a screener, pay attention to usability, customization, and data freshness. A clear interface helps both new and experienced users, while robust customization lets you tailor filters to your goals. Real-time data and reliable updates are also essential, so you can react promptly to market movements and avoid outdated signals. Screening criteria generally fall into three categories: fundamental metrics that assess financial health, technical indicators that analyze price behavior, and market capitalization filters that align candidates with your risk profile. Combining these criteria helps you balance value, momentum, and size to find stocks that match your investment objectives. Setting up a screener starts with picking a tool that fits your budget and skill level, then creating initial filters such as market cap, earnings, or valuation ratios to narrow the field. Don't forget to save your settings so you can rerun consistent scans over time and refine them as your strategy evolves. Fundamental metrics are central to value-based screening. Price to earnings helps gauge valuation relative to earnings. Earnings per share indicates profitability per share, and return on equity measures how efficiently a company uses investor capital. Together, these figures give a clear picture of financial strength and potential long-term value. Technical screening focuses on price and momentum signals. Moving averages smooth price action to reveal trends. The relative strength index shows overbought or oversold conditions, and volume analysis confirms the strength behind moves. These tools help time entries and exits, and complement fundamental insights for shorter-term decisions. Customize your screen to reflect personal goals by adjusting filters for growth, income, or risk tolerance, and combine multiple criteria to refine results for a specific thesis. Regularly update those filters so they reflect current market conditions and your changing priorities, keeping your screening process practical and aligned with your strategy. After you run a screen, interpret the results by looking beyond raw lists to evaluate why a stock appeared and whether it fits your plan. Identify promising investments, compare shortlisted candidates on performance and strategic fit, and use this analysis to prioritize deeper research and construct a high-conviction watchlist for monitoring. Creating a watchlist turns screening into ongoing monitoring. A watchlist helps you track potential investments over time, observe how they react to news or earnings, and decide when to act. Add stocks based on financial health and trend criteria. Then review and refine your list regularly to align with market shifts and your goals. In our case study, we'll highlight a chosen screener, walk through the step-by-step methodology used to identify candidates, and summarize the outcomes and lessons learned. This practical example demonstrates how consistent criteria, disciplined filtering, and follow-up analysis can produce actionable investment ideas and measurable results. Avoid common mistakes, like overcomplicating filters which can hide opportunities, ignoring broader market trends that affect even strong picks, and stopping research after an initial screen. Successful screening requires clarity, context, and follow-up investigation to separate meaningful signals from noise and manage risk effectively. Advanced techniques include combining multiple screeners to cross-validate ideas, backtesting strategies on historical data to assess robustness, and participating in user communities to learn practical tips and new approaches. These methods help refine your edge and increase confidence in the candidates your screens produce. Integrate screeners with portfolio management tools, news platforms, and social trading networks to build a fuller decision-making ecosystem. Linking data sources streamlines monitoring and execution, while news and social insights help you stay aware of catalysts and sentiment that could alter a stock's outlook. Evaluate screening performance by tracking outcomes against your expectations, refining criteria based on what works, and learning from historical results. Regular performance reviews help you identify strengths and weaknesses in your approach and ensure the screening process evolves with market conditions and your investment goals. For further learning, explore reputable books that cover screening strategies. Sign up for online courses and webinars to deepen practical skills, and follow financial websites and blogs for ongoing market insights. Curated resources accelerate your learning curve and keep you informed about new tools and techniques. To wrap up, remember the main takeaways. Screeners save time, improve focus, and help surface opportunities when used thoughtfully. I encourage you to start screening with a simple set of filters. Iterate as you learn, and stay open to new tools and trends that will shape screening in the years ahead. Now we'll open the floor for questions, so you can clarify uncertainties or dive deeper into specific points. Feel free to ask about techniques, tools, or scenarios from your own practice. And if you've tried screening before, I invite you to share experiences so we can discuss practical lessons together. Gathering feedback after sessions like this helps improve the screening process and presentation. So please share what worked or what was unclear. Use that input to refine your filters, documentation, and workflows, and commit to continuous learning to keep improving your investment decisions over time. When choosing tools, compare top screeners for features and cost. Look at pricing structures to find value within your budget, and read user reviews to understand real-world usability. Balancing functionality, affordability, and community feedback will help you pick a tool that supports sustained screening and analysis. Keep ethical considerations front of mind by integrating responsible investing principles like ESG into your filters, avoiding schemes that artificially inflate prices, and protecting confidential data when sharing research. Responsible screening promotes long-term market integrity and better alignment between investments and values. Networking with other investors through groups, online forums, and mentorship accelerates learning and exposes you to diverse strategies. Engaging with experienced investors helps you test ideas, get practical feedback, and refine your approach based on lessons learned in real market conditions. Looking ahead, advances in technology and the growing role of AI are reshaping how screeners identify patterns and predict opportunities, while market dynamics will continue to evolve. Stay adaptable. Experiment with new analytics tools, and consider how predictive models might complement but not replace your judgment. Finally, reflect on your investment journey, acknowledge progress and setbacks, and stay engaged through questions and discussion. Thank you for participating. And remember that screening is a skill developed over time. Stay curious, keep refining your process, and use these tools to support disciplined, informed investing.